Over the years, the market structure of crypto has very much changed. Not only the market cap grew from one high to the next, we've also seen the kind of investor changing from very early days, the OG cypherpunks, to afterwards the retail investor, to now Wall Street. That change in market structure has also an impact on returns. What we're seeing here is Bitcoin's long-term price chart in blue and the 30-day rolling return, the 30-day return on investment, and that's in percent as the red line. Now we can clearly see how in the early days Bitcoin tended to be much more volatile than it is today. So over the span of 30 days we got 4 or 5x returns to the upside, but also minus 60, minus 70% risk to the downside. And both the upside volatility but also the downside volatility is declining. Now taking 30 days as a cutoff point for the rolling ROI is quite arbitrary. Once we increase that window, so we don't just look at 30 days and look what is the performance from 30 days ago to today, but we actually expand that window to like 60 days, 90 days, 1 year, 2 years, 3 years, we do see a quite interesting development as well. So let's make the switch from 30 days to 90 days. The red line now oscillates less because we're smoothing out the returns, and in the absolute peak over the course of 90 days, Bitcoin once saw an almost 40x return. Again, we can draw those two lines. What's interesting though is that the slope of this upper line tends to be steeper than the slope of the lower line. In other words, it seems like the volatility to the upside is getting muted more than to the downside. And you will see more and more the longer we go with the time frame. So instead of looking at 90 days, have a look at this. This is 180 days. The green line, by the way, that's just break even, right? A 1x return. The price 180 days ago is the exact same one compared to today. Interestingly enough, again, the tops somewhat align, so do the bottoms. But once we extend the time horizon to 1 year and beyond that, we see that it's really the upside that's getting more and more muted, and that the bear markets are actually still as bad as they used to be. In other words, risk adjusted, Bitcoin is becoming worse and worse of an investment over time. We get less upside, we get the same downside. And here is what I mean. This is the 1 year rolling return. In the worst case, at the peak of the bear market, we are down to 20% of our capital, or we have a drop of 80% during the bear markets. The bull markets, though, are less pronounced over time. We used to have a 200x over the course of a year. That then went down to 100x, to 20x, to 10x, and recently just 4x. Have a look at those lines. Again, bull markets are less and less impressive, but bear markets are just as painful. By the way, if you so far enjoy this content and you don't want to miss future videos, then feel free to subscribe. I publish videos regularly over here. What I also find interesting is how we tend to bounce from one extreme to the other. So we don't really see hitting the lower end several times until we go back up. We're just going from depression to euphoria, to depression again, to euphoria, and currently we are rather on our way down. 1 year ago, we had the same Bitcoin price. In other words, an ROI of 1. No loss, no gain. And so let's move from 1 year to a 2-year rolling return. Again, the bottoms align very well. The tops also show a story of diminishing returns. Now at some point the structure has to break, right? Because the upper line and the lower line has to cross. So at some point we might see a breakout. But so far there isn't too much excitement around crypto. Crypto adoption is rather slowing down, relatively speaking. The growth isn't anymore what it used to be. And so check out this. That's probably the worst of the charts. This is the 4-year ROI. So that's the return on investment over a cycle. We are including the bull market with the bear market. We tended to have somewhat between 10 and 100x returns. Now we tend to be between 1 and 10x returns. And the overall trend again is very clear. Returns are diminishing over time, and maybe it's just hopeful thinking that we're suddenly going to bounce from here. I think the prior charts show a much cleaner picture, that we tend to go towards not so bullish times. The fundamental problem really is that the Bitcoin, despite its very high volatility, can't really beat other risk-on assets anymore. And that's probably the reason why many of the OG investors that were looking for outsized returns are now starting to take more and more profit. When returns diminish that massively, then why hold when prices aren't necessarily historically cheap? This is Bitcoin relative to the Nasdaq 100. And over the last 4 to 5 years, we didn't really see that much more outperformance. We could even extend this to the last 8 years. Yes, Bitcoin did do better than the Nasdaq 100 by roughly 24%, but we are on our way down. We might as well move into the negatives in the not so distant future. And then this was the peak at 20K. If we don't get any additional performance versus other risk on assets, why do we take on all of that potential risk of more than 80% or potentially 70% bear markets? If the volatility is so high, then why shouldn't we just time the market when buying and holding and ignoring the cycles doesn't really yield that much more outperformance? Just have a look at the selling of the wallets that have held Bitcoin for at least 7 years. This is recently accelerating massively. And again, I do think that's because of the diminishing returns and because of the lack of outperformance versus alternatives. And so if that's really the story, if we have to wait for Bitcoin to become very cheap in order for it to be attractive again, then how long do we have to wait? I'd say at least until we hit the average cost basis of the market, the realized price. So this is when historically Bitcoin was a good buying opportunity. Whenever the average Bitcoin investor was in losses, it was the best time to bet against the momentum. Now that cost basis currently is at 56K. And so we'd have to fall below that level for Bitcoin to potentially be able to outperform other risk-on assets again. Maybe at 56K, the OG whales will stop selling again. As they did in the past, right? They tended to sell less when the price was very depressed. Maybe it's better to not just wait until we hit the 56K. Maybe we even want to wait until the long-term holders are in losses as well. So the long-term holder realized price tends to be lower than the realized price of the entire market. And again, we tended to fall below that at the end of the bear market. We only briefly hit this during the COVID crash, but in general, if we enter a real bear market now, we might fall below the long-term holder cost basis as well. And that's currently at 38K. And so I think it's just wise to have proper risk management in place, to not be 100% exposed to Bitcoin or to crypto in general, to also own other asset classes, ideally asset classes that do not have a lot of correlation with crypto. For example, long-term government bonds, for example, active trading strategies where we might ride the ups and the downs of the Bitcoin market, something that is not one-on-one correlated with the delta exposure of the market. By the way, those rolling return charts, they all come from Into the Cryptoverse. So that's the premium membership by Benjamin Cohen's YouTube channel. Feel free to check it out. There's plenty of other useful information in his membership. And while he might not agree with everything that is said in this video, it is useful to get access to that data. If it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time here on YouTube. Cheers.